Hi everyone. Welcome to what can only be described as our highly anticipated next installment from the CTWM Investment Committee. I'm here with John Shanley, who's the Assistant Director of the committee. My name is Jarrett Solomon, just a mere member of said committee. So we come to you today for two reasons. We're now more than a quarter of the way through the year. We just wanted to check in with you and let you know what we're looking at, what we've seen, etc. And we also have a tactical shift in our target portfolios that John momentarily will go through. So when we connected with you at the start of the year, we talked about some themes that we thought would be prominent as 2021 unfolded. Among those were valuations, and among those were yields on the bond side. So far, both of those themes have proven in the first 3 months of the year to be on the forefront of return drivers and so forth. But in general, the market and economy had some pretty strong headwinds in Q1, not without caution. But some pretty strong headwinds from more vaccinations, and as global commerce unthaws or continues to unthaw, additional stimulus injected into the economy, more people being hired, and in some cases rehired. Broadly speaking, world markets appreciated about 5% in Q1. It's a great start to the year from a market perspective. We have seen wide-ranging performance among sectors and among asset classes, which speaks to that valuation theme that I mentioned before. And I think, John, is a good segue into some of the things that you wanted to discuss as well.
Absolutely, Jarrett. I would highlight that idea that broad ranges and dispersions and what works and what doesn't highlights why we believe in diversification. And I think that theme is only getting stronger and stronger by the day. Before we jump over to the trade, though, I would also add that on the equity side, markets were really strong. On the fixed income side, we saw a couple more headwinds. We started the year with interest rates at about 1% on a U.S. government bond. They got up to about as high as 1.75, so we saw a pretty big uptick in a short period of time. And in that environment, some bonds struggled. We joke about it a lot, but struggling for a bond means that you're flat or down 1%, so it's nothing like equity markets. And anything, it means that income now is a little bit higher from these bond funds. So the attractiveness of bonds today is probably even better than it was a few months ago. That story then leads us to the trade that the investment committee recently agreed to. We will be slightly reducing our growth and quality stock position and adding that into a value position. And before we get into the reasons, let's travel back in time a little bit. About this time a year ago, it was in March 31st of 2020, we made a trade in our portfolio where we started to have a more dedicated exposure to those growth quality type of stocks. The idea was that in a work from home environment where the economy was really shutting down, it was these capital light companies that would do really well. And fortunately, right, we're here a year later and that has played out. A lot has changed though since then. You mentioned valuations, right? Those quality names have been bid up a little bit, so they're a little bit more expensive. And we're also at a new area in the economy. Jarrett, you mentioned, but GDP growth is estimated to be anywhere between 5 and 8% for this year. Those are numbers we haven't seen in decades. So when we think about what type of investments do well in those timeframes, those value type of companies, think of industrials and financials and energy, they tend to do well in that type of environment. So we're going to add a new allocation to the portfolio, have this value tilt on one side. I should say, back to the idea of diversification, we're not running from one side of the boat to the other. We're just adding an extra level, and I think an important level of diversification to the portfolio.
Yeah, and I'll just say this is a continued theme on which we've been focusing for a few years now, and it comes back to what we were saying about valuations and looking for pockets of opportunity, right? There's been a wide dispersion in investment performance this year, and what it ultimately comes down to is that price matters. Price matters when you go to buy a couch, it matters when you go to buy a car, and it matters when you go to buy a financial instrument like a stock or a bond, whatever it is, as far as what your actual return experience will be, whether you're getting a good deal, and so forth. So That's not always the case over shorter periods of time. Other factors can drive investment performance over longer periods of time. We're all long-term investors. Price does matter. So that's the theme of this particular trade, and frankly has been the theme of some of the shifts that we've made over the past 2 or 3 years. So as always, please don't hesitate to reach out to us with any questions. And again, we thank you for spending a few minutes with us today.